Hey everyone, welcome to The Explainer. I am absolutely thrilled to be your guide today. Let's kick things off with a quick question. What if I told you that you could get paid up front, literally in cold hard cash, just for offering to buy a stock you already want to own and at a massive discount? I know. It kind of sounds like one of those late night infomercial pitches, right? But I promise you, there's no catch. This is a completely legitimate, incredibly powerful, and highly beginner-friendly strategy that's used in the stock market every single day. It's called selling a cash secured put. And today, we're going to break down exactly how it works, step by step, to make the whole shebang crystal clear. To really wrap our heads around how a cash secured put works, let's just step away from the stock market for a second. Let's anchor this using a real estate analogy and a theoretical $1,000 bill. Imagine there's this gorgeous house in your neighborhood that you absolutely love, and it's currently worth $400,000. Now, imagine walking right up to the owner and saying, "Hey, I love this place. If the price of your property drops down to $350,000 anytime in the next month, I promise I will buy it from you at that discounted price. But to lock in that promise, you got to pay me $1,000 cash right now."
And this brilliantly illustrates exactly what we are doing in the stock market. The mechanics map over perfectly. In our house analogy, if the real estate market crashes, well, you get the house at a massive discount and you still keep that $1,000. But if the housing market stays hot and the price never drops, you never buy the house, but you just walk away with a free $1,000 anyway. That exact structure is the reality of selling a cash-secured put. You keep the premium, which is that cash payment no matter what happens. The only difference is we're doing this with shares of great companies instead of real estate.
Okay, let's dive into this with part one, choosing the right stocks.
The first, and arguably absolutely crucial step of our playbook is picking the actual asset you're making this promise on. You can't just pick any random ticker symbol you see trending online. Instead, you need a golden rule. Seriously, etch this into your memory. Never, ever sell a put on a stock you wouldn't be completely happy owning for the next 10 years. Why is this so critical? Because if the stock price does drop below your target price, you're legally making a contract where you will absolutely be forced to buy it. You are on the hook. So, you better actually want to own that company. So how do we filter the good from the bad? First off, you want to completely avoid the hype train penny stocks, bankrupt crypto companies, and wildly volatile biotech firms. Just drop them. Instead, we're looking for high-quality blue-chip companies with incredibly stable earnings. Think the Apples, the Microsofts, the Coca-Colas of the world. You also want highly liquid stocks, meaning millions of people are buying and selling them every single day. This keeps your trading fees low and means you can get in and out of your trades with ease. A great rule of thumb is this. If you look at a stock and think, "Man, I'd love to buy this if it just dipped 10%, boom, you found your perfect candidate.
Moving right along to part two, timing your entry.
Once we've got our ideal stock picked out, we really need to talk about timing. You never want to sell a put when a stock is just ripping to an all-time high. The market moves in waves, right? And we want to execute this strategy when the stock is resting, cooling off, and taking a breather. To find that resting phase, we look for something called support. Think of a stock chart kind of like a bouncy ball in a room. The ceiling is resistance, and the floor is support. Support is simply a price level where a stock historically stops falling and bounces back up, because all the buyers suddenly step in and say, "Wow, this is a great deal." So when we make our promise to buy the stock, we want to set our target price at or just below that historic floor.
Now, what's really interesting about this slide is we can actually take all the guesswork out of timing by using a super simple indicator called the RSI, or Relative Strength Index. Now, don't let the fancy name intimidate you. It is just a simple momentum thermometer that reads from 0 to 100. If the RSI is above 70, the stock is overbought. It's running too hot, so we sit on our hands. No selling puts yet. But if the RSI drops below 40 or even down to 30, it's oversold. The stock has been beaten down, fear is in the market, and that is a prime environment for us. Because when fear is high, the cash premiums they pay us get really juicy, and a bounce back off that floor is highly likely.
All right, part three, timeframes and strike prices.
So, picture this. You've got your great blue chip stock sitting right on the support floor with an oversold RSI. Beautiful. Now you actually open up your brokerage account to make the trade, and you're immediately faced with two big choices. First up is your time frame. This is your expiration date, how long your promise actually lasts. The absolute sweet spot for this strategy is 30 to 45 days out. And why this specific window? Because options contracts have a built-in timer called time decay. As that expiration date gets closer, the option loses its value faster and faster. And since we're the ones selling the option, we want it to lose value. We want it to become completely worthless, so we keep all the money and the contract just expires. That decay curve accelerates massively right in that 30 to 45-day window.
Next up is the strike price. This is the exact, specific price you are promising to buy the stock at.
When you look at the list of prices in your broker, you're going to see a column labeled Delta. I want you to look for a 0.30 delta. While delta is technically a measure of price sensitivity, smart options traders use it as a probability cheat code. A 0.30 delta basically means the option has roughly a 30% chance of hitting that target. Flipping that around, by picking that strike price, you're giving yourself a roughly 70% mathematical chance of winning the trade outright, keeping all the cash and never even having to buy the stock. It puts the math firmly in your favor.
Let's move to and see how this builds with part 4, the simple trading checklist.
We've covered a lot of ground today, and I want to lock this into your memory with a final rapid-fire recap. This is your playbook for success right here. 4 core steps. Step 1. Pick a stable, highly liquid stock that you'd honestly be happy owning for the next 10 years. Step 2. Wait for it to take a breather, dipping near a support floor with an RSI momentum gauge below 40. Step 3. Open your broker and go 30 to 45 days out on the calendar to absolutely maximize that time decay. And finally, Step 4. Pick a strike price right around a 0.30 delta to give yourself a solid 70% probability of keeping the premium free and clear. If you just follow these 4 steps, you're actively collecting consistent income while setting yourself up to buy the world's greatest companies at a steep discount.
We've reached the end of our explainer today, but I want to leave you with a quick action item. Ask yourself, what stock would you love to own if it dropped 10% today? Think about that for a second. Seriously, write that ticker symbol down, pull up its chart, and start looking for that support floor. Thank you so much for joining me in this focused learning session. Take this knowledge, apply it carefully, and I'll see you in the next explainer.